It's midnight. You're scrolling through real estate listings, and every house that isn't falling apart seems to start at $500,000. It's got laminate counters from 20 years ago and a yard the size of a postage stamp, yet the listing agent calls it a perfect starter home. You start doing the mental math on your salary and wonder, did I miss a memo? Is everyone else just making way more money than me? Today, we're going to do something your real estate agent probably won't. We're going to look at the brutal math of what it actually takes to own a $500,000 home in 2026, because there is a massive difference between what a bank will approve you for and what you can actually afford while still being able to sleep at night. Let's start with the first hurdle, the down payment. The old-school rule of 20% means you need $100,000 in cash. If you're earning the median U.S. income of $84,000 and saving 10% of your gross pay, which most people aren't, it would take you 12 years just to save that down payment, assuming prices don't go up. So most people put down 5% or 10% instead, but that unlocks a poverty tax called PMI, private mortgage insurance. You'll pay an extra $200 to $400 a month just for the crime of not having $100,000 in the bank. That money doesn't build equity, it just protects the bank in case you fail. Now, let's look at the all-in monthly cost. This is where the math gets scary. Principal and interest at a 6 to 7% interest rate, you're looking at roughly $2,850. Property taxes add about $500 a month. Insurance, another $300. Maintenance, the rule of thumb is 1% of the home's value per year for when the water heater explodes at 11 p.m. That's $417 a month. PMI, tack on that $300 fee. Your total monthly cost is $4,367. To keep that at a safe 28% of your income, your household needs to be making $187,000 a year. Even if you stretch yourself thin, you still need at least $150,000. But only about 10 to 20% of households make that much. This means for 80% of Americans, a $500,000 house is a financial stress simulator. Imagine a couple, the Johnsons, making $160,000 a year. On paper, they're upper middle class, but after that $4,300 mortgage, car payments, groceries, and student loans, they're spending nearly half of their take-home pay just to keep the roof over their heads. It feels like checking your bank account before buying eggs. It feels like saying no to your kid's field trip because that $35 might be needed for a check engine light. It's a life where you are one unexpected expense away from disaster. The HVAC breaks, that's $5,000 you don't have. Someone rear-ends you, your $1,000 deductible goes on a credit card. Here is the truth that culture won't tell you. There is no trophy for being house poor. We've normalized this misery and called it adulting, but real wealth isn't a set of keys to a house that owns you. Real wealth is margin. It's having the freedom to invest consistently, to sleep without anxiety, and to handle a crisis without a credit card. If the math doesn't work for a $500,000 home right now, it is okay to walk away. Renting and investing the difference isn't throwing money away, it's buying yourself time and flexibility. Don't let a Zillow listing dictate your happiness. Build your foundation, keep your margin, and remember, real success is waking up and deciding what you want to do with your day, not what you have to do to pay for your walls.